In this video, I want to highlight reasons why penny stocks can be risky. Investing in penny stocks can be enticing due to the potential for high returns, but it also comes with significant drawbacks, significant pitfalls. And so here are some key risks that are inherent in penny stock investing. Number one, high volatility. Penny stocks can experience extreme price fluctuation in a short period, making them highly volatile and unpredictable. Because of the high volatility, they fluctuate a lot, they are highly volatile. You can hardly predict the price movement of a penny stock, and they do that within a short period. Number two, lack of liquidity. Many penny stocks are thinly traded, meaning it can be difficult to buy or sell a large amount without impacting the stock price because of the fact that the volume of shares outstanding is relatively low. So any buying of a large amount of shares or selling of a large amount of shares will impact the stock negatively, as the case may be. Number three, limited information. Penny stocks often belong to smaller, less established companies that may not be required to provide comprehensive financial disclosures, making it harder to assess their true value and risk. For the fact that they are listed in the OTC, that's over the counter kind of over the counter markets, they are not expected to provide the level of information that could be demanded in larger exchanges like the NASDAQ or the New York Stock Exchange. So they are somewhat opaque. They have a limited financial disclosure, and that makes them very hard to fully value or understand the risk they come with. Number four, high risk of fraud. Penny stocks are more susceptible to scams and manipulative practices such as pump and dump schemes, where the stock price is artificially inflated and then sold off by insiders. What happened here is that insiders will buy the stocks at a higher volume. They buy high volume of stocks, and as they're buying consistently, the stock keeps on rising. At a particular point in time, when it has risen enough, when it goes into their targets, they will sell the stock. In larger volume, the stock will plummet almost automatically. That kind of procedure, that kind of process is called pump and dump scheme. Number five, poor long-term performance. Poor long-term performance. Many penny stocks belong to companies with uncertain futures or limited potential for growth, which can lead to poor long-term investment performance. These particular stocks are stocks of emerging companies, new companies with untested service or technology or products. And so if you invest in this particular stock, the capacity for long-term performance is relatively limited because they are just new in the market, not yet tried or tested, and you could sustain losses along the way, and that will impact your overall investment portfolio at investment return at the end of the day. Number six, potential for complete loss. Due to the speculative nature of penny stocks, there is a certain risk of losing your entire investment. These stocks are highly speculative, and that's why you don't just put your entire capital in penny stocks. You diversify into other more stable, more predictable, less risky investments. If you concentrate your entire capital, in a penny stocks, you are likely to lose your entire savings, your entire capital. So you don't do that because the potential for loss is relatively very high. Number 7, high transaction cost. The bid-ask spread for penny stocks can be wide, leading to high transaction costs when buying or selling shares. In this particular buying and selling and procedure, there's a bid aspect and there's a sell aspect. There's a bid aspect, there's an ask aspect, and so there's always a spread. And that spread, when it comes to penny stock, is somewhat wide. And because it is wide, it will lead to what? It will lead to higher transaction costs. Number 8, regulatory risk. Penny stocks are often traded over the counter or on less regulated exchanges where the oversight is less stringent, increasing the risk of regulatory actions or delisting. Unlike the more popular exchanges, penny stocks are not traded in the better established popular exchanges. They are traded over the counter, and for that reason the oversight over penny stock is somewhat limited, and then even the listing requirement is not as stringent or strict as what is obtainable in the bigger exchanges. And so for that reason, these stocks can be very easily delisted. That is, they can be taken out of the markets, and once that is done, there's always the possibility of an investor losing his money. Please subscribe to this channel and give me a thumbs up. It will help me a lot to do me a ton of good. Number 9, difficulty in valuation. Difficulty in valuation. It's difficult to value. With limited financial data and high volatility, accurately valuing penny stocks can be challenging most of the times. So making informed decisions could be a bit difficult because of the limited volume of information available when it comes to penny stock investing. They don't really supply, they're not demanded to supply much information compared to if they're listed in other established exchanges. So you find it very difficult to make informed decisions because you have no complete data, you have no complete information to be able to help you to make your investment choice. Number 10, emotional trading. The allure of quick profit can lead to impulsive decision, causing investors to buy or sell based on emotions rather than sound fundamental analysis. There's always that particular temptation to make quick profit because the stock fluctuates, it fluctuates frequently, and of course it's very volatile. So one could be tempted to do what? To sell. Immediately the stock climbs or rises to a particular level, you want to sell. And so by so doing, you are making impulsive decisions, not based on fundamentals, not based on reason, not based on logic, but because the stock had risen, you want to take profits. That's not a good way of investing. You stick to fundamentals, you stick to logic, and you are guided by strong reason. That's how to make money in the markets over the long run.